Welcome to Open Wire News. If you're trying to figure out the real timeline of a coming global conflict, you need to stop watching aircraft carriers. They're just theater, designed to be seen. Military hardware can be a training exercise, a diplomatic signal, or it can disappear in a matter of days. If you really want to understand a nation's intent, watch what moves slowly. Watch sovereign debt. Debt is heavy. It's slow. It takes months, even years, to move large positions quietly. So when a superpower starts dumping its rival's debt at a rapid pace, it's not just rebalancing its portfolio. It's clearing the decks for what's next. This week, the US Treasury released its latest data, known as the tick report. Most people just glance at the headline number and move on. We're going to dig deeper into what the market is ignoring. As of October 2025, China's official holdings of US Treasury bonds have fallen to about $688 billion. This is the lowest level we've seen since May 2009. Think about that. 16 years of economic integration are being systematically erased. Let's put this in perspective. Back in 2013, at the peak of the China and USA trade era, China held about $1.32 trillion in US Treasuries. The system was simple. China funded American deficits. Americans bought cheap Chinese goods, and China recycled those dollars right back into US government debt. It was a perfect loop. Well, that loop is now broken. China has sold off roughly half of its peak holdings. But the really shocking part isn't just that they sold, it's when they sold. They sold heavily throughout 2024 and 2025, a period when the bond market was weak, bond prices were depressed. Selling into a down market like that often means locking in significant losses. In the world of asset management, you don't sell at a loss unless you absolutely have to. Either you're facing a liquidity crisis, or you believe the asset you're holding is about to become toxic. China isn't having a liquidity crisis. They still run massive trade surpluses. So the data points to one unavoidable conclusion. Beijing now sees US Treasuries as a dangerous liability. To understand why, let's rewind to February 2022. When Russia invaded Ukraine, the West's primary response wasn't with tanks. It was financial. They froze around $300 billion of Russia's foreign currency reserves, almost overnight. Beijing was watching very closely, and they learned a critical lesson. Any reserves held in Western jurisdictions can be frozen with the flip of a switch. So, in a potential crisis over Taiwan or in the South China Sea, those US Treasuries aren't a safe asset. They are a vulnerability, a hostage. From that perspective, taking a smaller, manageable loss now is far preferable to risking a total loss later. This isn't a market panic, it's a strategic liquidation. It's a financial burn notice. This brings us to the next logical question. If China is selling, who is buying? For decades, the United States could run massive deficits because there was always a reliable buyer in the East, ready to absorb the debt. That buyer is not only stepping away, but has now become a seller. In a normal, functioning market, this kind of heavy selling pressure should push bond prices down and send yields or interest rates soaring. Higher yields would be incredibly painful for the US economy. Mortgage rates would skyrocket. Banks would come under immense strain, and the cost of servicing the national debt would explode. But the market hasn't completely snapped. Yet, why not? Because a new group of buyers has stepped in. America's allies. The same tick report that shows China selling reveals some very unusual increases elsewhere. Let's look at the United Kingdom. Its holdings of US Treasuries have surged toward record highs, hitting roughly $750 billion. The UK's economy is a fraction of the size of China's, so this level of buying is highly unusual. It strongly suggests some form of financial engineering is happening through the City of London, with the UK acting as a kind of financial shock absorber. Then there's Belgium. Its holdings are fluctuating between $320 and $370 billion. Belgium is home to Euroclear, one of the world's largest securities settlement hubs. This means that the Belgium holdings are often a proxy for other international players who hold their assets there, not the Belgian government itself. So, you have the UK's holdings up, Belgium's holdings up, and China's holdings way down. This doesn't look like a series of independent, free market decisions. It looks like coordinated action. A bag-holder alliance, designed to prop up the market. But this strategy has a fatal flaw: capacity. China was able to buy trillions in treasuries because it had a massive surplus of dollars from its export machine. America's allies don't have that same firehose of cash. Supporting the US bond market forces them to drain liquidity from their own economies. It weakens the periphery to protect the core. And what happens if one of these allies runs into its own economic trouble? They might be forced to sell those very same treasuries to raise cash for themselves. If key allies start selling at the same time China is selling, that's when yields could finally jump, and the whole system could break. At that point, the only buyer left with deep enough pockets is the US Federal Reserve itself. And that changes everything. If the Fed is forced to step in and buy government debt on a massive scale just to stabilize the market, it's essentially creating money out of thin air. That puts immense downward pressure on the US dollar. This is precisely why China no longer wants paper claims. They are moving their wealth into assets that cannot be frozen or devalued by a printing press. So, where is all that money going? It's going into the physical world. First, gold. Gold has no counterparty risk and no sanctions switch you can flip. Second, energy. In a conflict, stockpiles of oil and gas are critical. Third, copper and other strategic minerals. These are the essential inputs for power grids, electric vehicles, batteries, and advanced defense systems. And finally, food. Calories are a core component of national security. A nation at peace will always optimize for financial yield. A nation preparing for conflict optimizes for survival. That's why selling bonds at a loss can be a perfectly rational decision if the trade-off is buying real-world resilience. This fundamentally changes the meaning of US treasuries. They are no longer just a boring, safe investment. They are now an active part of geopolitical strategy. They are becoming a battlefield. So here's the OpenWire News framework for navigating this. And let me be clear. This is for context, not financial advice. Rule 1. Shorten your duration. Long-term bonds are the most exposed to rising interest rates and geopolitical risk. Short-term T-bills, on the other hand, behave much more like cash and carry far less risk. Rule 2. Consider owning real assets. Things like energy and industrial metals can provide a hedge against currency pressures and inflation. Rule 3. Watch the allies. Keep a close eye on Japan and the UK. If their currencies start to break, their ability to support the US bond market will break with it. That is the ultimate warning signal. That $688 billion number isn't just a piece of data in a government report. It's a countdown. The economic divorce between the world's two largest powers has been finalized. Now, we're just waiting for the house to be sold. This is OpenWire News. Thanks for watching.